Morning, everyone, and welcome to today's first session, where we are joined by Nicholas Yeo, who's head of the China and Hong Kong equities team at Aberdeen, and manages the Aberdeen China Investment Trust alongside co-manager Elizabeth Quick. China has been a mainstay of investor portfolios for many years now, and has grown into the second largest financial market in the world after the US, with more than 5,000 listed companies and a value of more than $17 trillion. This is a pivotal moment for China and its relationship with the West, and we think this makes it a fascinating time to hear from an expert on the market and on the country. So please do make use of your access to Nicholas by asking questions using the Q&A function on your screen. Nicholas, over to you.
Thank you, Pascal. Definitely interesting time for China right now, Chinese equities. So I will start with a famous quote that you are aware of, that you have heard of, from Winston Churchill. I won't give you the full quote, but you probably know what it is. If you're going through hell. So I'll stop at that and stop at that particular quote for now. And then I will peer through the current noise in the markets and share the reasons for keeping faith in Chinese equities. I know there are 4 topics over here, but I'm going to cover mainly 3 topics. The first being the introduction to the concept of all China. Secondly, we will introduce you, ACIC, and the team and the processes behind ACIC. And finally, key investment themes, as well as the outlook for Chinese equities this year. So intro to Chinese equities, or sorry, I should say all China. Now, first of all China refers to all Chinese companies, regardless of their place of listing. So this could be listed in the US, listed in Hong Kong, or mainland China. Yeah. And the reason why we pick all China are as follows. Firstly, breadth of the market. If you have all the companies accessible to you, regardless of whether they are listed in Hong Kong or mainland China or ADRs, we have full access to the opportunity set. But as you can see here, it is still the mainland Chinese market that is called China A that has the most number of listed companies. The rest of them, you might be a little bit confused by the alphabet soup here, that you have the P chips, H shares, red chips. This all refers to companies listed in Hong Kong. Yep. As I said, by having a very broad universe, regardless of where it is listed, it gives us the opportunity to invest in the highest quality Chinese company. And the Chinese equities market, collectively, Hong Kong or onshore, is one of the deepest in the world. It is number 2 behind the US in terms of market cap and in terms of liquidity. And as you can see here, once again, the China A share market, onshore market, has the deepest market cap, or the deepest liquidity amongst the Chinese companies or Chinese markets, either onshore or offshore. Now, the all China universe provides the full opportunity set. It is quite interesting that as of now, some domestic companies, such as the liquor company that we call Baijiu, this is the hard liquor companies, they are only listed in mainland China. On the other hand, some of the large internet companies there is in the news frequently right now, as well as the e-commerce companies, the larger ones are only listed offshore, either in US or in Hong Kong, or Hong Kong, I should say. Now, another reason why we wanted Chinese equities to be your strategy in the ACIC is that it gives you something different from the rest of the world in terms of correlation. If you have a look here, the correlation of MSCI China All Shares is only at 0.5 versus against S&P 500. And this is important because it gives you uncorrelated returns. But of course, you may argue that in recent weeks, that correlation or that low correlation seems to have broken down. In fact, the correlation has been very high. I will touch on that later on as well. But by and large, over the long term, over 15 years, the correlation to developed market is low. Now, on this particular slide here, you will see that index providers such as MSCI has a low inclusion factor for domestic A shares in the global indices. Now, we believe that this does not reconcile with the size of Chinese GDP or the contribution of Chinese GDP to the rest of the world in terms of global growth. So in the global context, it seems to be unfairly or unjustly unjustly allocated a weight that is too low. But upon full inclusion, Chinese equities, regardless of whether they are onshore or offshore, will account for more than half of the global emerging markets index. When will that day come? It could be 5, 10 years, but we have seen, in other markets that it takes around 8 to 10 years. And as a result of the low allocation in the indices to Chinese equities, foreign participation in the A share market, this is the onshore market, is still small at 5% compared to 20 to 30% in other Asian markets. So there is a lot of room for foreign participation to increase in mainland China equities. Now, with that, I turn to the next topic, which is introducing you to the team and the process behind ACIC. Firstly, how are we different? Now, I have grouped the differentiators in 3 roles. The first role is related to our ESG focused and integrated investment process and the resources that's available for analysts in terms of doing the ESG analysis. The second role is what I call our intangible advantages. We are steep in our heritage of investing in the Chinese markets for 30 years. Myself, this is my 21st year with Aberdeen. And we do have a local presence of analysts and fund managers on the ground in Hong Kong, in Shanghai. And we do not adopt a star manager approach. It is very much the team approach that you might have heard about us from Aberdeen. On the final role here is the differentiator that is related to our product. Our product is high conviction, high quality, with 40 to 60 stocks in the portfolio, and it is also more focused on consumption story or domestic consumption story compared to our competitors. Lastly, this is a full opportunity set. It is not restricted to A share or Hong Kong. It is the full opportunities that you can get. So what is the philosophy that is driving the strategy behind the way that we invest in Chinese equities? Now, the investment philosophy here is best described as long-term quality. In other words, holding quality companies for the long term. So what is the strategy? It is actively managed bottom-up stock selection with a long holding period. Our average holding period on an annualized basis is less than 20%. So how is it managed? First-hand research is paramount. We will not invest in a company without meeting the management first. We are not benchmark driven, but we are benchmark aware. We have a strong emphasis on ESG and stewardship. And lastly, the outcome that you get is a high quality portfolio with higher return on equity compared to the benchmark, as well as a balance sheet that is stronger than the benchmark. So a little bit more about the philosophy here. The quality, once again, is the centerpiece of this long-running strategy. We have been running open-ended strategy for a very long time, close to 30 years as well. So quality has always been our main method of uncovering the best companies in our 30 years of investing in China. Now, what do I mean by quality? It is defined by 5 factors. As you can see here in the wheel of quality, firstly, the attractiveness of the industry characteristic, whether it is one with plenty of growth in the long run. Secondly, it is also the superior competitive advantage that the company enjoys, or in Warren Buffett's words, the competitive moat that it has to defend its business model. Yeah, and as well as on another factor, which is the management factor, the management execution has to be strong, management pedigree has to be good. So this is another factor that we focus on. Lastly, ESG, an important consideration, especially when it comes to investing in China. There is still a lot of room for companies to improve on ESG. Now let's touch on the team that is involved in the management of the Chinese or the research of Chinese equities. We have given you the Asia Pacific equity team layout. If you want to focus on the Chinese team members, it is they are the members highlighted in blue. It is also one of the largest Chinese teams with 14 members located in Hong Kong, Shanghai, and Singapore. It is a diverse team in terms of gender, experience, age group, and as well as the provinces where they are drawn from or they come from. We have members who are from Sichuan, Shandong, Guangdong, various parts of China. The Singapore-based members, the Chinese team that involve some of these Singapore-based members, they also wear the regional hats, which gives us a broader perspective on the quality of our Chinese companies. I think that's the major value add by including some team members in Singapore. Then again, not all 14 members are involved in the construction and day-to-day management of the portfolio. It is the pod, or what we call the POD, the pod of 4 of us, who is responsible for the management of the trust. Now, the advantage of having a smaller team managing the day-to-day as well as the construction of the trust is speed of the decision making. We are much quicker to decide what we want to do with the portfolio, and it also increases the accountability of individuals to the trust performance. Now, very quickly again, I will touch on the investment process here, starting with idea generation, followed by the research that we do after idea generation, and then finally peer review. Of course, the last step will be the portfolio construction. Now, very briefly, we do not start the universe at 5,000 names. There's just too many. We are looking to build a scalable and liquid portfolio, and as a result, it is not a hard limit, but we exclude any companies that is below 1 to 1.5 billion US dollars in market cap. So with this filter, it cuts down the universe to around 2,000 names. So the starting universe is 2,000. And with these 2,000 companies, we applied 3 other filters for idea generation. The first being a quantitative screen that we use. It is a proprietary software that helps to generate ideas based on some of the factors such as quality factors, earnings growth factors. By plugging in these factors, we are able to screen companies that we liked, and sector review as well, which is done by the leads, the sector leads. He or she will highlight the stock in the sector that could be worth taking a deeper look. And lastly, we have done company visits over 30 years, collected a lot of database on these visits. So through these visits, we have already screened out many companies that do not meet our quality criteria. And with this idea generation, we go to the next step, which is what we call the research coverage. And there's around 130 stocks that we cover after the filtering process. And this is the 130 stocks on a more dynamic basis. We will we'll go through some company visits. We'll do some desktop research. And if companies do not meet, are unlikely to meet our quality screen, then we will replace them. So it is a dynamic process. But if there are companies that are more likely to meet our quality criteria, we'll put them through the next stage, which is peer review. I mean, this is where the analyst's investment thesis on the stock that he or she is promoting is being challenged by the rest of the team. And lastly, portfolio construction. I will not go into detail here, but basically only companies that pass the peer review are moved to the portfolio construction stage. And in terms of the sizing of the position, we ensure that there is alignment with the level of conviction on the stock. And also we will consider liquidity, valuation levels, and portfolio construction factors such as adequate risk diversification. So that's all part of the portfolio construction. On ESG itself, it is, like I mentioned already, it is core to our investment process. We integrate it in our research, as well as drawing expertise from our on-the-desk ESG specialists. There are 3 sitting on our desk in Singapore. And with the help of the analysts, or with the specialists, I should say, we engage with the companies, the investee companies, to help them to improve on their standards of ESG, but at the same time, to show our disapproval as well if you're not happy with some of the measures in their ESG standards or in their ESG policies. And lastly, we believe that the outcome is a positive one because companies that are able to improve on their ESG standards are more likely to deserve a premium over time. This is something that we have observed in terms of alpha generation from engaging with the companies and helping them to improve on ESG standards. So last topic over here, the key investment themes and outlook. So very quickly, again, this is based on our 5 investment themes observed from a bottom-up research over the years. And this can be summarized into 5 names or themes: aspiration, digital, green, health, and wealth. So what do we mean by aspiration? Basically, it refers to consumption upgrade. The big picture here is that household in China with an annual income of more than 22,000 a year is growing at 70%, is estimated to grow at 70% from now until 2030. So that is the kind of growth of wealth in China that will spur consumption upgrade. Digital refers to innovation, being a key development driver to lift China out of the middle income trap. This could be internet, this could be hardware, software, this could be semiconductors. So these are all under digital. Green, I think you have probably heard a few times already about the carbon neutrality target that China has by 2060. So the country is embarking on huge decarbonization investment over this long period of time into the future. Health, I think if I tell you the big picture, you will probably understand why we want to focus on health. The median age in China right now is 37 years old, but this will increase to 46 years old by 2050. This demographic problem, as well as the rising wealth, will spur strong demand for healthcare services. That's why it is an area that we want to focus on, health. Wealth, similarly, like I mentioned earlier on, The demand to manage wealth is huge. An example will be insurance products. The penetration rate of such products in China is still very low at less than 5% of GDP. So lots of room for growth in terms of the population needing more wealth management services. Now, this flowed through in the sector allocation as well. As you can see here, we are overweight consumer, we are overweight healthcare, and in industrial, we are overweight because there are a number of names related to green, related to decarbonization. Some other information that you may find interesting is that we have quite a large allocation to A share at around more than 60% of the trust is tilted towards the A share. There's a lot more domestic in terms of exposure, and that's what we liked. And small and medium-sized companies represent around 16% of the trust. So another area where we could generate alpha, given that small cap companies are usually, like everywhere else, under researched by the analyst community. Yeah. And this is the top 10 holdings. Once again, as you can see here, high conviction, top 10 account for 41% of the portfolio. Some of these names are in internet, are in consumptions, are in healthcare. So a variety of names in the top 10. Yeah. Now, very quickly on the outlook, we are still constructive on Chinese equities because given the recent sell-off, when I say recent, it is these few weeks, Chinese equities are even cheaper now. We are talking about Chinese equities trading at 1 standard deviation or even 1.5 standard deviation below the 5-year historical average at around 14 times PE I should say 13 times PE or 12 times PE. It is definitely, very attractive compared to the developed countries or developed markets like the US. Yet earnings growth continue to be healthy. We are still forecasting earnings growth for the Chinese market to be around 15%, which is still respectable growth in China. Now, some of you may be, I'll focus a little bit on the long-term outlook first. Some of you may be concerned about what you're hearing or what you're reading about Chinese government regulatory tightening, especially in the internet, e-commerce, real estate sectors. You are hearing a lot of regulatory tightening news. However, to put it in a perspective, put it in the context of the aim that the Chinese government is trying to achieve, it is aiming to achieve a long-term stability, especially in terms of the social equality front, narrowing the gap between the rich and the poor, as in many other countries in the world. So that is the main objective. But of course, there are many other objectives as well, like you can see here. So it wasn't that easy in terms of trying to balance the different policies in order to achieve the stabilities. And so instead of the misconception that the Chinese government is taking money from the rich or large corporation and giving it to the poor, we do not think so. We think that the government aims to level the playing field to encourage social mobility, as well as increase competition in innovation-related sectors like internet or technology. So that is what the regulatory tightening was meant to do. However, the rollout, the execution of the announcement or the execution of the rollout of the policy was a little bit lacking in terms of coordination between different regulatory bodies. And at the same time, we believe that they're getting their act together. The regulatory noise should moderate this year. Most of the major announcements have been made last year, so there should be less of that big announcement this year. And at the same time, perhaps some of the regulators were wanting to be seen as doing a lot on the regulatory front, and they might have been too enthusiastic in terms of rolling out some of these policy. But we should see less of that this year because it's already into the second year, and government officials are already up for election, so there's less of a need to showcase some of this eagerness this year. Finally, the government is also aware that the regulatory tightening has produced unintended consequences with slowing employment rates at some of these big internet or technology companies. So that's why we believe that regulatory noise should be less this year. Now, keeping to the long-term outlook, we believe that there are two pain points that China wants to alleviate. The first is that, as you can see here in this slide, it imports about close to 300 billion US dollar of semiconductors, as well as 250 billion of oil and gas. These are strategic commodities that the country wants to be self-sufficient in. Hence, the push for onshoring of semiconductor production, as well as the investment in renewable energy and electrification of vehicles. And in doing so, they would not need to import so much oil and gas from the rest of the world. And as you can see here on energy self-sufficiency, the quest for decarbonization is not just China-centric, it is global. And arguably, it has been accelerated by the Russia-Ukraine conflict. Now, China has a key advantage here because it is a global market leader in renewable supply chain. For example, in the solar energy supply chain, it is a market leader, a global market leader, I should emphasize, at 91% market share. So before I summarize and pass it back to Pascal, you may want to, hear a few words about the recent market sell-off in China. We believe that it is a confluence of three main factors coming together at the same time. Number one, geopolitics spillover from Russia-Ukraine conflict. Number two, the potential delisting of Chinese ADR by SEC, the US regulators, as long as the regulators has no access to audit papers in China of these listed companies. And number three is the Kovite resurgence in China. Now, very quickly on geopolitics, China's trades with EU, US, and US airlines in Asia Pacific are 20 times bigger than that with Russia. So it is only logical for China to stay out of the controversy related to the conflict. On the potential delisting of the Chinese ADR by the SEC, the regulator, we were quite surprised because this has been talked about for more than 3 years. We are surprised by the very big market reaction when some of these companies were put into that list to start the delisting process, which will take around 3 years. So this is something that is not new, but we were very surprised by the reaction of the market. Was the market not aware of this? So yeah, that's something that puzzled us as well. But we believe that the impact is not that big because a lot of these Chinese ADR companies have started or have already moved some of their shares to Hong Kong in the form of a secondary listing. So the trades can continue in Hong Kong. At the same time, the Chinese regulators are also in talk with the US regulators to resolve the current issue with regards to gaining access to the audit papers in China. Lastly, the Kovite resurgence. Now, China is an old hand when it comes to handling the pandemic. It is still sticking to the dynamic zero COVID strategy. So lockdown in district is not uncommon. However, the government is very swift in nipping the infection in the bud so that it stops spreading rapidly. And so after the lockdown in some district, economic activity can resume. And now, if you were to ask me when China will lift the zero COVID strategy, it is still, an unknown for now. But I mean, the government is flexible about exploring alternative to this strategy. So I would just say that potentially there could be changes to this costly zero COVID strategy. So finally, I should say that the horrific selling of the Chinese equities in the last few days is sentiment rather than fundamentals driven. And it's time for us to be contrarian buyers in such a irrational market in our view. Finally, going on to this slide, the summary of the outlook for 2021. China is in the opposite of the monetary and fiscal policy to the West. It has room to ease on both fronts as compared to the West. Earnings of our holdings, of our investee companies are holding up well, and valuations have been even more attractive after recent sell-off. Now, China has a profound structural growth opportunities in spending upgrade, digitalization, going green, health, and wealth. So this is why we wanted you to remain in the Chinese equities or keep your faith in Chinese equities. Now, if you are going through hell, going back to the Winston Churchill quote here, if you are going through hell, keep going. It feels like that in the Chinese equities right now. But we believe that the long-term attractiveness of investing in Chinese equities is still very much intact. So I'll stop here and pass it over to Pascal.
Thank you, Nicholas. That was a great presentation. We've got lots of questions here. I'm just going to dig them up.
Okay.
First one, it's one we've talked about ourselves on Kepler Trust Intelligence a few times, but it's looking at the size of China and the sort of the strength of China as a part of the index. Calls have been growing to split it out of the emerging markets indices and just make it a separate thing. Do you think that's likely? And if so, do you think it's desirable?
Well, I think it ultimately will be driven by demand of investor. If it was to go down the route of Japan, it is a possibility, splitting that out from Asia Pacific, right? So there is a Japanese equities as a standalone asset class. Now, interestingly, we are hearing more clients around the world wanting to do that as well. So they will be looking at global emerging market ex-China, but at the same time, they feel that they do not have enough exposure to China. They want to keep it as a separate asset class. That is a growing trend and one that will continue to spur more demand for Chinese equities over the long term.
Okay. Another one we have is, can you talk to us about how you actually own the A shares? I think somebody's been looking at your fact sheets, and I've seen that Aberdeen China A share fund is one of the routes you use to own A shares. And I think the question is really why do you do that and not invest directly? What's the benefit of owning the A shares through an Aberdeen fund? And also, is there any kind of rebate on the fees for that?
Yeah, thank you for your question. The investment in the China or Aberdeen Aberdeen China A share fund is an interim measure. We are in the process of winding that down. It's a legacy holding. Now coming back to the first question, we invest via the Stock Connect, and we're also in the process of getting a QFI license. It is pending. It is coming soon. Now with the QFI license, we will be able to tap into that, drawing from the gradual liquidation of the fund and to invest in the A share directly, because some of the stocks are still not accessible via the Stock Connect route. We still need a QFI. So don't overemphasize on the Aberdeen fund. It will be wound down as we get our QFI. Yeah.
Great. Obviously, sentiment has been part of the presentation you've made, talking about sentiment and how that impacts on equities. And obviously, with Chinese equities being such a fascination for us here in the UK, we're aware of that sentiment and how much it swings, particularly more recently in more recent years. How does that affect your ability to deliver returns as a stock picker? And are there any ways you can mitigate it? Because I know there are some trusts in that part of the world that use derivatives, for example, to sort of play against the index and take out the market risk. Is there any mitigating work you could do to sort of
Yes.
work? Yeah.
No, thank you for your question. It is similar to FX. We don't take FX hedges. It is, in short, very difficult to call market sentiment. Like, for example, today, it's fortunate that we have a call today. Market recovers after 2 or 3 days of crazy selling. And who would have guessed, right, that today we will see a very big rebound. The Hang Seng Technology Index rebounded 20%, 20. This is the index rebounding. It's not the stock rebounding. We have seen stocks up 40%. So it is very hard, to be taking hedges against market movement, because the Chinese market ultimately remains low in efficiency. It is still, especially the A-share, it is sentiment driven. It is retail dominated, and even the institutional investors in China are short term in nature. So we would not want to be overly clever about calling the markets. So what do we do is that we actually do the contrarian. As I said, we know the companies well, and if a stock is being dragged down by sentiment, we'll do the opposite. But the key here is that we have to know the companies well. So when there is irrational selling, we do not follow the market. We will go the opposite direction, and that is the way to generate alpha over time. And we have done that successfully in the A-share market, especially. Yeah.
Thank you. Earlier in the presentation, you said that before you invest in any company, you meet the managers. An obvious question, given the last couple of years and us all being locked in our houses. How has that affected your Chinese team, particularly given that lockdowns are still taking place? How has that affected your ability to do that? And what do you do to get around it?
So, by the way, the lockdown in China is dissimilar to the lockdown that you might have heard about in the UK or in Australia. It's not complete lockdown of the whole city. It's district by district. It has been changing. It has been dynamic in terms of the strategy. So some of our members are able to travel. They are able to go to other provinces as well. And so that is one way that we have mitigated the company visit. Is we have our guys in Shanghai, and we are committed to increase our resources in Shanghai. We have 3 members in Shanghai, and we are increasing that number there. And they are the ones that will do the leg work for us, kicking the tires by visiting factories. And ironically, because of the COVID situation, Chinese companies who used to be less willing to meet up over Zoom or like something like this are coming around that reluctance, and they are much more willing to pick up the call, much more willing to do a Zoom with us. So meeting the companies is not just going down to the factory, but also seeing them, meeting them frequently over Zoom. Or we don't really use Zoom; we use Tencent meetings in China.
Yeah. How much of the portfolio's underlying company revenues are based purely on domestic demand, as in not internal companies selling out to foreign countries, but are literally within China, and what they're selling to is within China as well?
Okay. Thank you for your question. I may need to get back to the exact number, but I can share with you for that 65% of our A-share exposure, the bulk of the A-share exposure is domestic revenue derived. I would say that 90% of that 65 will be deriving their revenue from from China. Now we have some of the the e-commerce internet companies that you have seen in our top 10. Even then, Meituan, Tencent, these guys are also predominantly Chinese revenue. At the fact that they invest overseas, it is still a predominantly Chinese derived revenue company. So it is a very high component of domestic revenue. Yeah.
Yeah. What's the house view on kind of globalization? It's probably a rather grandiose question, but what is the house view on globalization? And does the fact that you've got this high exposure to domestic focus, and you said China itself wants to be less dependent on outside sources of strategic assets or materials?
Yes.
Is the view that globalization will continue to retreat, or do we think that's not the case?
No, we don't think that's the case. I might have maybe incorrectly overemphasized the need to be self-reliant. Yes, the government, the Chinese country as a country wants to be more self-reliant, self-sufficient, especially on the key commodities. But at the same time, they're very willing to trade with the rest of the world. There is this dual circulation. The dual circulation is not just domestic circulation, but also circulation to the rest of the world, especially with emerging countries. And the EU has been relatively friendly as well. So so far, I think the trades between EU, emerging world to China is still growing. And in fact, with the 2 to 3 years of COVID situation, China has increased its market share in exports, while many other emerging countries are in a lockdown and not able to produce. China has taken up that role. So as you can see here, the evidence is that they do not just want to rely on one engine, which is domestic demand. They still want to rely on 2 engines. And they will have that competitiveness as well when it comes to technology over time. They will be in the opposite of, they will be not exporting, the low-end products, but they'll be exporting, some of these high-end technology over time, which they have started already for the last few years.
Yeah. But two more questions, because we're getting close to the limit. But how is gearing used in the fund?
Yes.
I don't think you've talked about that so far.
All right. Yeah, I mean, we have the room to use gearing, and we are open to using gearing. However, with the volatility of the market, we have to be using gearing in a more measured way. So we will not be sudden increase in the gearing. It will be more stepwise, like 3%, 5% of the NAV. Will remain conservative as always when it comes to gearing. And as you can see, Chinese equities is highly volatile, and you don't want the banks to be calling us. Yeah.
Yeah, and is that when you say that using conservative, are you using it in a structural way, so it's just there in the background, or is it on an opportunistic basis where there are specific opportunities which might cause you to increase it?
Yeah, you'll be at a certain level, but of course, you'll be at a certain level, let's say to between 5 and 10%. But from time to time, whenever there's an opportunity, there is the big correction in the market, then we will increase that gearing for that period of time, and then look to reduce it as well when the market recovers or becomes too bullish, right? Yeah. So I mean, that is working in tandem with regards to how the market is performing, and hopefully it is opportunistic in that sense when it comes to the use of gearing.
Yeah. Last one is about discount, and just someone's obviously looked at the discount versus your peers in the same sector, and it looks like the discount is sort of more volatile than that of the other trusts in the sector. It's been to a higher level at certain points of the year. What's the reason for that, and what does the board do to control it, if anything?
Well, the first question first. Well, thank you for the question again. The volatility is related to Chinese equities. It is, as we have witnessed in the last few weeks, it has been highly volatile, and as a result, there could be a volatility discount being placed on such a strategy. But we believe that over time, as the market matures, as the economy matures, like every developing countries in the world, this volatility will also reduce. And with more foreign participation as well in the Chinese market, more understanding of the Chinese economy, that volatility will reduce over time. So I don't know how our discount is like compared to other Chinese investment trusts, but of course, when compared to maybe Asia Pac investment trust, the volatility will be higher, the discount might be larger because of that reason. And I think that is something that we have to live by. But in terms of what we can do is that the board and together with us, we will continue to do buybacks and try to narrow the discount when there is, irrational discount that is appearing. Yeah.
Thank you very much. Okay, I'm afraid that's all the time we've got for questions, because our next session is going to start in 14 minutes with one of your sister funds, Asia Dragon. If you've not registered for that, there's still time to do so. You'll find an article on the website homepage which lets you do that. Meantime, thank you all for joining us and for the questions you've submitted. And thank you, Nicholas, for your time today. It's been a really fascinating hour.
Thank you, Pascal, and thank you, everyone.
Thank you. Bye.
Bye.